Interest rates affect your mortgage, your credit cards, your savings account, even the entire economy. But who actually controls them? Today we're breaking down how interest rates are set, who influences them, and why they matter, using information from the Federal Reserve, the U.S. Treasury, and global financial institutions. Interest rates are the cost of borrowing money. They influence everything from home loans to business investments. Higher rates make borrowing more expensive. Lower rates make borrowing cheaper. In the United States, the most important interest rate, the federal funds rate, is set by the Federal Reserve, specifically the Federal Open Market Committee, or FOMC. The FOMC meets about 8 times a year to decide whether to raise, lower, or maintain rates. The federal funds rate is the interest rate banks charge each other for overnight loans. It may sound small, but it influences almost every other interest rate in the economy. The Federal Reserve looks at key economic indicators, including inflation, employment, consumer spending, business investment, global economic conditions. Their goal is to keep inflation low and employment high, known as the Fed's dual mandate. When the Fed raises rates, loans become more expensive. Credit card interest rises. Mortgage rates increase. Savings accounts may pay more. When the Fed lowers rates, borrowing becomes cheaper. Spending increases. Businesses invest more. Yes, banks set their own interest rates for loans and savings accounts, but they base those decisions on the federal funds rate. When the Fed moves, banks follow. Mortgage rates are influenced by the federal funds rate, the bond market, inflation expectations, investor confidence. They don't move exactly with the Fed, but they tend to follow the same direction. Interest rates are also influenced by global factors, including international trade, foreign investment, global inflation, central banks in other countries. The U.S. is part of a global financial system, and rates reflect that. Most countries have their own central banks, such as the European Central Bank, the Bank of England, the Bank of Japan, the Bank of Canada. These institutions set their own benchmark interest rates. Interest rates influence housing markets, stock markets, business growth, inflation, consumer spending, national debt costs. They're one of the most powerful tools in the economy. Thanks for watching. If you want more clear explanations of everyday topics, hit like, subscribe, and check out the next video in this series.